Today, you are going to learn capital structure within just 5 minutes. Building a business is like building an empire. All that is required are resources, strategy, and most importantly, a solid capital structure. Don't let the fancy term fool you. Capital structure is just a fancy way of saying how you pay for your dream. So, capital structure refers to the mix of different sources of funds that a company utilizes to finance its operations and investments. It represents the combination of debt and equity a company employs to meet its financial needs. Striking the right balance in capital structure is crucial for a business's long-term success and sustainability. Now let's discuss the two main components of capital structure. First, debt. Debt is basically the funds borrowed by a company that must be repaid over time with interest. It includes loans, bonds, and other debt instruments. Companies often leverage debt to finance projects, acquisitions, or to manage cash flow. Here are some advantages of debt. 1. Tax deductibility. One of the primary advantages of debt is its tax deductibility. Interest payments on debt are generally tax deductible, providing a financial edge and reducing the overall tax burden for companies. 2. Cost effectiveness. Debt financing often carries a lower cost of capital compared to equity. This cost effectiveness makes it an attractive option for companies seeking to optimize their capital structure. And the disadvantages of debt including: first, financial risk. While debt can amplify returns, it also escalates financial risk. High levels of debt create a situation where a company might struggle to meet its debt obligations during economic downturns or challenging business conditions. And second, fixed obligations. Unlike equity, debt comes with fixed obligations. Companies must make regular interest and principal payments, irrespective of their financial performance, potentially straining cash flow. Now, let's discuss the second component, equity. It represents ownership in a company and is typically in the form of common stock. It represents the residual interest in the assets of the company after deducting liabilities. Investors receive returns through dividends and capital appreciation. Some advantages of equity including: 1. No obligation to repay. Equity represents a form of financing with no mandatory repayment obligation. This characteristic provides companies with greater financial flexibility, especially during challenging economic periods. And 2. Shared risk. Equity investors share the risks and rewards of a company's performance. This shared risk fosters a sense of alignment between the company and its shareholders. Here are some disadvantages of equity. First, dilution of ownership. Issuing new equity, especially through additional stock offerings, can dilute the ownership stake of existing shareholders. This dilution is a consideration that companies must weigh carefully. Second, cost of capital. Equity financing may be more expensive than debt, primarily due to the higher expected returns demanded by equity investors. This can impact a company's overall cost of capital. So, how much debt and equity do you need? It's like baking a cake. Too much flour makes it dry, too much egg turns it rubbery. You gotta find the perfect balance. Determining the optimal capital structure involves a nuanced assessment of various factors, such as: 1. Industry norms. Different industries have distinct capital structure norms influenced by the nature of their operations, capital intensity, and risk profiles. 2. Interest rates. Fluctuations in interest rates impact the cost of debt and, consequently, the attractiveness of debt financing. 3. Risk profile. A company's risk tolerance and overall risk profile play a pivotal role in shaping its optimal capital structure. Understanding and navigating the complexities of capital structure is important for companies aiming to achieve financial stability, flexibility, and sustainable growth. A well-crafted capital structure aligns with strategic goals, enhances resilience in dynamic markets, and positions companies for long-term success. If you want to read capital structure in details, go through the link in the description and download the PDF. If you think this video is helpful, please like this video, and subscribe to my channel. See you in my next video.